So that is a precipitous drop here, an 18% chance when just this morning we had a 90+% chance that we would see a September rate hike. What does this all mean for you and your money? Let's begin first with former Atlanta Fed President Dennis Lockhart, who wrapped up his term in February. Now, we hope he can freely speak and say all sorts of controversial things. And Bill Lee, former senior economist at the New York Fed, now the chief economist at the Milken Institute. Dennis, I'll begin with you. That's a pretty stunning reversal for Fed funds futures, is it not? What does that mean, that they don't believe Janet Yellen's one more rate hike this year?
Gee, I'm very surprised myself at that reversal by the markets. Perhaps the market is inferring that the September move could maybe spill over to December, something like that. The markets, the broader markets, that is the equity markets, may also be reflecting that the Fed is getting on with the removal of accommodation, but at least by explaining very thoroughly how the normalization of the balance sheet is going to work, and that this normalization process is moving on. So the accommodation is being, to some extent, removed on a gradual basis.
Okay, you know, I just don't believe that number. So we are definitely checking with the CME, but the last we had seen was 98% chance. That would make more sense. But all right, I want to bring in Bill Lee here. What worries you about the economy? It almost seemed like inflation was the key word here. Inflation, of course, is the power of prices to rise. And at 1.7%, that's significantly lower than the 2+% we had seen for inflation back in January.
Yeah. And Liz, you hit it right on the money. The uncertainty that's being introduced by the data is also compounded by the uncertainty that Chair Yellen is introducing by saying we're going to deal with the balance sheet. Because after all, there's really no good reason why you need to address the balance sheet. And what it does is it causes people to say, well, how are they going to normalize? Is it rates or is it going to be the balance sheet? And what's the combination thereof? One of the things that is most concerning is that the verbiage says we are going to focus on rates, and therefore but at the same time we want to drop the balance sheet. There's nothing in theory that says the balance sheet can't stay where it is, and in fact even grow with GDP. That reducing uncertainty is something the chair should be doing, and yet you see from the market reaction right after her press conference, she's actually introduced more uncertainty by introducing this balance sheet versus rates.
And I completely agree, especially on the point where she disagrees with the president. And Dennis, the president says we will have 3% growth in a couple of years. She's saying no, by the end of 2019, we'll be at 1.9%, which is actually lower than 2018, which is a 2% GDP.
Well, the committee overall, the consensus of the committee, the median projection showed that series of 2%, or I think 2.1, 2, and then down to 1.9 by the end of the projection horizon. I think that is a way of saying that the fiscal stimulus that had been expected several months ago has been very slow to develop, and that forecasters within the Fed and the governors and presidents who contribute to the SEP, the economic projections, are simply not making an assumption on fiscal stimulus. What they are reflecting is the economy as they see it today, and the outlook for the economy based on its functioning independent of any fiscal stimulus.
Well, listen, those are a lot of fancy words that I just want to make sure our viewers understand that there is no guarantee we'll see 3% rate, GDP rate.
My own view is that we have some, call them long-term headwinds in the form of demographics, in the weak productivity growth. I think overcoming some of those headwinds is a heavy lift, and I think it's difficult to assume that we're going to get to a sustained level of 3% easily. And I really believe that you have to build that economy, and it takes time.
Liz.
Yeah, go ahead, Bill.
Liz, there's no doubt we're going to see a stronger rebound in second quarter GDP. One of the things that we're not sure of is whether we're going to see inflation go up as the Fed anticipates. I think we're going to see lower inflation ahead of us before we see higher inflation. And even though we have that low unemployment rate, everyone is freaking out that there's no slack in the economy. In fact, the unemployment rate is a lousy indicator of slack. And in fact, what you should look at is the pace of hiring. Hiring now is at the slowest pace relative to job openings in the history of the data. And I think the fact that you don't hire means that there's no wage increase, there's no inflation. That's what the market is starting to sense, and I think that's the uncertainty the Fed has to address. What are you going to do if inflation starts to sag behind your trajectory? Are you going to ease up on normalization, or at least are you going to ease up on the balance sheet?